Welcome back to Learn SKN, and today we're going to finally conclude the May-June 2019 CSEC Economics Paper 2. And so it's been a while that we did question 4, but today we're doing question 5. We're going to complete this paper. But before we complete this paper, you know what to do. Like the video, subscribe to the channel so that it can grow and we can, pass this on to more and more persons. And of course, you hit the bell so you know when Learn SKN drops another economics video. Alright, so let's just jump right into it then. 5A1. Define each of the following terms. And the first term we see here is trade liberalization. Trade liberalization. And then we have preferential tariff. So again, okay, so what is trade liberalization? Now what trade liberalization is the removal or reduction of barriers or restriction that between trading nations. That's as simple as it is. It's the removal or the reduction of restrictions or barriers to trade among nations. So that's trade liberalization. You're freeing up trade. So it's basically freeing up or making trade a little easier among different countries, different nations. So trade liberalization is the removal or reduction of barriers or restrictions to trade among different nations. You put that, you get your nice 2 marks. Then we have preferential tariff. What is a preferential tariff? Now a tariff by itself is basically a tax on imported goods. So maybe somebody's importing something and when it lands on an island or on a country, they have to pay X amount of tax before it can go for sale or can be passed on to the customers. So it's a tax. Now a preferential tariff would be a tariff or a tax that is lower for some nations than it is for others, or it's lower for some trade partners than it is for others. So they're saying is that they're going to charge different nations or different trading partners a lower tariff or a lower tax for the importation of those goods. So that's a preferential tariff. So whichever nation gets the lower one, they're receiving preferential treatment for that trading arrangement. So a preferential tariff is a tariff or an import tax that is lower for some nations compared to others. So that's a preferential tariff right there. You get your 2 marks again for the nice definition. Alright, part 2 for question 5. State the meaning of each of the following acronyms. So 1 mark for each. So just state the meaning. So you just FTAA and you just outline what that is, and you get your 1 mark for that one. And you have it right here in the textbook. FTAA, Free Trade Area of the Americas. Free Trade Area of the Americas, and that's the acronym for that one. And of course you have CDB, and that would be the Caribbean Development Bank. So you don't even have to look for that one. CDB is the Caribbean Development Bank. Alright, so those are the 2 meanings of those acronyms. Alright, so next question. Discuss 2 benefits of the CARICOM single market and economy to Caribbean territories. So we're talking about CSME now. So what are the 2 benefits of CARICOM or CSME to Caribbean territories? So let's just turn to our textbook. The benefits of CSME. So the CSME, when fully operational, will be a single market and economy. Theoretically, such a union will bring to its members certain benefits. It is hoped that in time, members in the CSME will, and of course we have them listed here, a lot of them actually, give each country access to a larger market for its goods and services. So that goes without saying, you want to be able to trade. So CARICOM in itself is a trading block. And so with CSME, you're going to have a free movement of people, free movement of resources, of capital, and things like that. And so you can bring your business from one country to the next. So if you're operating in a business, let's say in Antigua, now Antigua would not be your only market. Now on the CSME, you can think of the wider Caribbean as your big market space. So you'll be able to export to member territories at, of course, free entry, free trade, and those kind of things. So when you say give access to larger markets for its goods, so you're looking now at, instead of the maybe let's say the 50,000, 100,000 persons in the smaller Caribbean, we're looking at a larger pool, 6 million people in the Caribbean region as your market. So it gives each country access to a larger market for its goods and services. And you can see that being played out. Because if you look at some certain countries like Barbados and Pine Hill is all across the Caribbean. It's in most of the OECS, it's in Windward, Leeward, and Pine Hill is all over. Not to mention Grace Goods all over the Caribbean. Not to mention Charles Chocolate and Holiday Snacks and all those things all across the Caribbean. So it's not just a little island that's your market, but the larger Caribbean on a whole. This enable people of the region to improve their standard of living. So what they're saying here is that workers can now move because there's free movement of people. And I'm pretty sure you've seen it happening a lot of times. We have a lot of, well, I wouldn't say foreigners, but Caribbean people working across the region. Like right here where I'm at, there are a lot of Jamaicans here, a lot of Guyanese here. So, you know, that's partly because of CARICOM and CSME. And so you can move. If you don't have a job here, you can move to one of the other territories that you have a job. That is why we have CXC, right? Because CXC is across the board. So your qualifications in one island would work for any other island. You have UE, same thing. So it enables people to improve the standard of living by getting jobs elsewhere if they cannot get in their home region. Enable the region to improve its standard of work. Competition amongst labor will raise the quality of the labor force. So no longer are you just competing against persons in your country. That is why, again, I go back to CXC. That's why CXC have the regional awards, because you're not competing with just your classmates. You're competing with members, your cohort across the whole region for that year. So that causes you to bring up your game a bit. Alright, so you carry up your game, so you improve the standard of work across the region. Achieve full employment of labor. So, like I said before, if there's unemployment in a certain area, you can move, go to a next area and find work. So there will always be laborers available for whatever positions are out there not being filled. And so if you see a country desperately need police, or desperately need teachers or nurses or farm workers or whatever, if you're in a place that has all those in abundance, you can always leave and then go to that place that is in need. So you'll always achieve full employment as an economy. Expand trade and economic relations with states outside the region. Again, because of CARICOM, we negotiate as a trading bloc, and so that gives us a little more strength. Because imagine a small country going to the WTO, right? So you don't really have much of a standing if you're just a small island of 100,000 persons going to the WTO, which America with 300 million, China with 1.3 billion. You know, so as a small, as a nation, as a trading bloc, CARICOM as a one integrated economy, we can go and negotiate, and we can go and have a greater standing. 6 million is better than 5,000, 50,000, 100,000. So that gives us that strength to stand on because we're coming together as one. Improve levels of international competitiveness. As competition amongst member states will rise the quality of goods and services available for sale. So they're saying here that because all of us are competing within the region, Jamaica, Trinidad, Guyana, Barbados, all of us competing, that means we're going to rise the level of our products, of our goods, of our service to even rival international levels. Because that's the next step. Because to beat your regional competition, you have to go international. And so because you go international, you follow your HACCPs, you follow your ISOs and things like that, and that puts you on the level with international competition now. Because you're competing to be the best in this space. Increase production and productivity. Again, same thing again. Because you know that we have access to a wider pool of laborers, of workers, of skills. Those who are in it have to perform. You have to perform. So of course your productivity got to be up there, or else if you don't perform, you can easily be replaced from someone else within that larger pool instead of just your country, your smaller country. Increase inflows of new capital to the entire region. Again, because we're coming together as one, that means that a company in the international market can see our area as a viable space, a viable source to come and put down their business. Because what does that mean? If I put down a business in, let's say, St. Lucia or Dominica or whatever, I can now have access to the wider CARICOM region, the wider Caribbean region. So that would cause more inflows of, you know, new capital from the international scene. You come down, put down something big here, because you know that when push comes to shove, I can always branch out into the smaller islands up the chain in the Caribbean. Then they say here, introduce entrepreneurship and technology, create more opportunities to travel, work, and study in the CARICOM. You see, UWI is one good example of that, and all UTech and all the other universities. Provide opportunities for companies and individuals to invest. Same thing I said before about the cash flows, the inflows of foreign direct investment. Know that can allow for us to invest. Also, look at this. The OECs alone has their own stock market, and so any member of that state can invest in stocks on that market. Even still, as an integrated economy, we can invest in the Jamaica Stock Exchange, Trinidad, Guyana, whatever. You have other chances to invest. And so those are some benefits that the wider Caribbean can obtain from becoming a part of CSME CARICOM. Alright, and that's so much marks for that one. 8 marks. So you realize you have to pull to, and they said discuss. You have to understand these terminologies with CXC. Explain, discuss, compare, those kind of things. Discuss means it's gonna be some meat to it. So you pull one and you go to town. You're gonna be some meat to it. You discuss it. You look at both sides. You just see how these things, as I mentioned earlier, can benefit the region. So one you can easily pull would be, of course, competition. You can get a lot from that. You can get a lot for standard of living. This one, the very first one, larger market. That's a very easy one to explain away, right? And you can get a good decent 4 marks from that one, because it's very easy, very obvious, right? So you just go to town on the question, get your 4 marks each, and you're good to go. Okay, good. C. Country A has started to demand a large quantity of imports and has lost its focus on exporting its own goods. This has resulted in country A using more foreign currency to pay for its imports than it earned through exports. Wow, so see problems here. Using a supply and demand diagram, show the impact of country A's action on its currency supply curve. Its currency supply curve. Alright, good. So that's a simple one. Now let's outline what's going on here now. Let's outline what's going on here. Good. So country A has started to demand a large quantity of imports and has lost its focus on exporting its own goods. So what they're saying here is that, if you look at what they're saying here, they are importing more, right? They're importing more and exporting less, right? They're importing more and they're really taking on exporting. So what does this mean? If you're importing more, that means that the demand for your local currency would fall, right? Demand for your domestic currency would fall, because as I said before, this might be, you can clearly see from this thing, from this example, that it's a floating exchange rate, and so it's at the mercy of supply and demand, the market forces. Because you're exporting less, there's a lower demand for your currency, right? Good. But they're not the one. They want us to focus on demand. They want us to focus on supply. So they say, what happens to the supply curve? So what do you think would happen to the supply curve in this case? If everybody wants to import, what would they use to import? They want the foreign currency. And so now banks and other businesses now have to provide this foreign currency. And so there will be an increase in this foreign currency on the local market. And if there's an increase in the foreign currency, then what does that mean? Sorry, not the foreign currency. If there's an increase demand for the foreign currency, yes, then that means the supply for the local currency would go up, because people are gonna want to buy the foreign currency. So you want to buy more, and let's say in the Caribbean perspective, you want to buy more and more US. So what would happen now is that there will be an increased supply in the domestic currency in order to buy up more of the foreign currency. Let's talk about the textbook say about this whole thing here, the depreciation of the currency. This textbook said, it follows then that as foreigners demand less of the domestic currency, remember nobody exporting, so there's less demand for the domestic currency. Other things remaining constant, such as part of us, the currency depreciates. So let's say if the demand for the currency goes down, the value goes down, depreciates. There's a shift of the demand curve to the left. But remember, focusing on supply now. So supply we're looking for now. Also, as domestic residents and firms supply more domestic currency, because people are going to want more of the domestic currency to buy up the foreign currency. So let's say in Jamaica, you're going to want more Jamaican dollar to buy up the US dollar. Are you going to want more of the Trinidadian dollar to buy up the US dollar? Are you going to want more of the Guyanese dollar to buy up the US dollar, or more of the EC dollar to buy up the US dollar? And so that means that the supply will increase, because the firm supply, the bank's going to supply more, hotels going to supply more of the foreign currency, of the local currency to buy the foreign currency. See, as domestic residents and firms supply more domestic currency, that is, they wish to purchase more foreign currency for imports, holidays, or investment. In this case, in the question is for imports, because they're focusing more on imports. The currency loses its value, just like anything with supply and demand. If you flood the market with something, then it loses its value, the price goes down. Same way, if you flood the market with the domestic currency, then the value of that currency goes down, because you only wanted to buy the foreign currency. There's a shift of the supply curve to the right, and this is what we're looking at right here, this graph right here. Right, so the example right here, they're showing the price of TT in US. So in this case, the price of country A's currency in, if you want to say a foreign currency, good. Then you have the original equilibrium, where you have the demand curve, supply curve, and then we're just focusing now on the supply curve of things. So the supply curve is going to shift to the right, because there's an increase in the supply, because more people want more and more of the domestic currency to buy the foreign currency, because as it depreciates, that means you need more and more of that currency to reach the value of the foreign currency. For example, if let's say the EC dollar, right now the EC dollar is, if you want to buy 1 US, you need 2.71 EC dollars. That's the exchange rate right now, it's fixed. What if it was floating and the value of the EC depreciates, as in it falls? What does that mean now? You might need 3 EC dollars to buy just 1 US dollar. So now we need more of the domestic currency. And so banks and hotels are going to be willing to supply that for you to buy the foreign currency. And so there will be an increase in the supply of the domestic currency, and that would lead to a fall in the value of the domestic currency. And so the supply curve will shift to the right to indicate an increase, and then you see the equilibrium status paribus would change. Alright, so that's the diagram we're drawing here. That's the diagram we're drawing for that question. Right, so using a demand curve, show the impact of the country A's action on its currency supply curve. The currency supply curve going to shift to the right to indicate an increase in supply, because people want more of the domestic currency to buy the foreign currency to get their imports on. Alright, so that's 3 simple marks for that one. And all it's saying is just draw it, and of course you're going to indicate all of these pointers and show what was what before, then you come down, you indicate all of that, and you get your 3 marks. Alright, good. Next one. C part 2. I think that's the last question on the paper. Yep, last question on the paper. Good. So we would have we completed the 2019 right now. Explain the impact of country's action on the value of its currency. Oh wow, we just basically explained that. So you draw it up here, and then you explain it down here. That's all they're asking for. So the impact of country A's action on its value of its currency is the value will fall. So the currency is going to depreciate. And that's all that we outlining right here. Right? Depreciation. Because based on the diagram, you will see that yes, there's an increase in supply because the curve shifts to the right, but the value is going to fall. Right? Because there's a shift, the value is going to fall, and when the value falls, we call that depreciation. So there will be a depreciation in country A's currency, and it's outlined nicely in this little paragraph right here. It follows then that as foreigners demand less of the domestic currency, other things remaining constant, the currency depreciates. There is a shift of the demand curve to the left Also, as domestic residents and firms supply more domestic currency, that is, they wish to purchase more foreign currency for import in this case, the currency loses its value. There's a shift of the supply curve to the right. So we are explaining just the depreciation of the currency in its value. And that's what this last question is asking about, depreciation. A depreciation of a currency is a fall in the external value of the currency due to changes in the forces of demand and or supply. And that's what we're explaining right here. Alright, good. So you outline that, you get your 3 marks, and that's it for the May-June 2019 Economics Paper 2. Alright, so you know what to do now. Again, like the video, subscribe, and stay tuned when Learn SKN drops more videos. Thanks for watching, thanks for listening.